You are standing at an ATM at 11:47 at night. Not because you planned to be here, because you needed $40 and the ATM inside your bank closes at 9, and this is the only machine within walking distance, and it does not belong to your bank. And you know, before you press confirm, that there is a fee. $3.50. You press confirm anyway, because you need the $40, because you do not have a choice. Because choice, at this level of money, is something other people have. You walk home with $40 and a receipt that says your balance is $214. You do not think about the $3.50 for very long. You cannot afford to think about things for very long. There are too many things. But somewhere in a glass tower, in a city you have never visited, in a quarterly earnings report you will never read, that $3.50 has already been counted. Yours and the $3.50 of the 2.4 million other people who used an out-of-network ATM that same day. The number those $3.50 make when you add them together is not $3.50. It is $8.4 million in a single day from people who needed $40 and did not have a choice. This is not a story about banks being evil. Evil requires intention directed at a specific person. What this is more impersonal than evil, more structural, more difficult to be angry at because there is no face attached to it, no villain in a specific chair making a specific decision to take $3.50 from a specific person standing at a specific ATM at 11:47 at night. There is only the system that was built carefully and legally and over a very long period of time by very intelligent people whose job was to answer one question: how do we make money from money? And the answer they arrived at, the answer the entire architecture of modern banking is built around, is elegant in the way that traps are elegant. You make money from money by positioning yourself between people and their own money and charging them for the distance. That is the whole model. That is what a bank is. A very sophisticated, very legal, very profitable toll booth between you and your own life. You opened your first bank account at 17. Someone drove you to the branch. There was paperwork. A person behind a desk was friendly and efficient and explained the features of the account with the practiced warmth of someone who has explained the same features 11,000 times and has learned to make it feel personal. Free checking. No monthly fee if you maintain a minimum balance. A debit card. Online banking. Access to a network of ATMs. You signed the paperwork. You felt like an adult. You deposited $200. What you did not know at 17, what no one in that branch explained to you, what the paperwork, buried in language designed to be technically accurate and practically incomprehensible, was the precise mechanism by which that $200 was about to become significantly more valuable to the bank than it was to you. Here is the mechanism. When you deposit $200 into your bank account, the $200 does not sit in a vault with your name on it. This is the foundational misunderstanding. The money does not wait for you. The moment it enters the bank, it becomes the bank's asset, and your liability to them becomes a number in a ledger. The bank takes your $200. It keeps approximately $20 of it in reserve, the regulatory minimum, the amount required by law to be available if you ask for it back. The remaining $180 it lends to someone else, at interest, at a rate substantially higher than the rate it is paying you to hold your money. You deposit $200. The bank lends $180 of it to someone at 18% interest on a credit card. The bank pays you 0.01% interest on your $200. The spread between 0.01% and 18% is not a rounding error. It is the business model. Your $200 is working harder for the bank than it will ever work for you inside that account. And the bank is not doing anything illegal. The bank is doing exactly what it was designed to do. You just were not told that this is what it was designed to do. This is called fractional reserve banking. It is not a conspiracy. It is not hidden. It is taught in economics classes and described in textbooks, and available to anyone who looks for it. The reason most people do not know about it is not that it has been concealed. It is that the system has no incentive to explain it, and the school system never taught it. And so most people arrive at adulthood depositing money into accounts they fundamentally misunderstand. They think they are storing money. They are funding a lending operation. The distinction is not academic. The distinction is the reason the bank is profitable, and you are standing at an ATM at 11:47 needing $40. The first invisible mechanism, the overdraft fee. Your account balance is $47. You forget. Or you do not forget, but you miscalculate, because you are tracking 5 things at once and one of them slips. A subscription charges. An automatic payment processes a day early. A hold clears at a different time than you expected. The transaction is for $53. You have $47. The bank covers the $6 difference. The bank charges you $35 for covering the $6 difference. $35 to cover $6 for approximately 24 to 48 hours, which is an annualized interest rate of, depending on how you calculate it, somewhere between 5,000% and 17,000%. You would not borrow money at 17,000% interest if someone offered it to you explicitly. No one offered it to you explicitly. It happened automatically. In the fine print of the account you opened at 17, when someone drove you to the branch and the person behind the desk was friendly and efficient, and the paperwork was technically accurate and practically incomprehensible. The overdraft fee generates approximately $15 billion a year for American banks. Not $15 million. Not $150 million. $15 billion. From people whose accounts went negative by an average of $24. The average overdraft transaction is $24. The average fee is $35. The average person who overdrafts does it 6 times a year. 6 times. $35 each time. $210 a year. From a person whose account went negative by $24. And the people who overdraft 6 times a year are not the people with $200,000 in savings. They are the people with $47 in their account, tracking 5 things at once and miscalculating one of them. They are the people who can least afford the fee. They are the people for whom $35 is not an inconvenience, but a reset. Another month starting from behind. Another number to absorb that the number cannot absorb. The fee is largest where the margin is smallest. That is not a coincidence. That is the architecture. The second invisible mechanism, the minimum balance, free checking. No monthly fee if you maintain a minimum balance of $1,500. $1,500. For a person earning $34,000 a year, $1,500 sitting in a checking account earning 0.01% is not free checking. It is a $1,500 loan to the bank at 0.01% interest in exchange for the privilege of not being charged a monthly fee. The bank takes your $1,500, lends the majority of it out at rates between 6% and 24%, and returns to you a monthly interest payment of approximately 12 cents. 12 cents on $1,500. And if your balance drops below $1,500, the fee arrives. $12 a month. $144 a year, which for a person with an average balance of $1,200 who keeps dipping below the minimum because $1,500 is not a stable number at their income level, means the free account was never free. It was a trap with a $1,500 entry fee and a $144 annual penalty for not maintaining the entry fee, paid by the people least able to maintain a $1,500 buffer, not paid by the people with $15,000 in the account. The $15,000 person never pays the fee. The $1,200 person pays it every month they slip. The fee is not designed to punish the $15,000 person. The fee was never designed for the $15,000 person. You are 26. You have been banking at the same institution since you were 17. You have a checking account and a savings account and a credit card all at the same bank because that is what they suggested when you were 17 and it seemed convenient, and you have never thought to question it because the system rewards not questioning it with the appearance of simplicity. Everything in one place, easy to manage, familiar. What you do not know is that the credit card you have with this bank is charging you 22.9% interest on a balance of $2,800 that you have been carrying for 11 months. And the savings account you have with this bank is paying you 0.03% interest on the $900 you have managed to set aside. The bank is charging you 22.9%. The bank is paying you 0.03%. The difference between those two numbers, the spread, the gap, the distance between what the bank charges you and what the bank pays you, is the profit. Your profit, flowing in the wrong direction, every single month, while you maintain the relationship out of familiarity and the appearance of convenience. The third invisible mechanism, the credit score. Your credit score determines the interest rate you pay on every significant financial decision of your adult life. Your mortgage, your car loan, your credit card. The rate at which you borrow money for the next 30 years is largely determined by a 3-digit number calculated by private companies using proprietary algorithms that you do not have full visibility into. A good credit score saves you tens of thousands of dollars over a lifetime. A poor credit score costs you tens of thousands of dollars over a lifetime. And the behaviors that build a good credit score, paying bills on time, maintaining low utilization, keeping accounts open, are behaviors that are significantly easier to maintain when you have money. When the balance is not $47. When the automatic payment does not occasionally overdraw the account. When you are not choosing between paying the minimum on the card and covering the grocery run. The system rewards financial stability with cheaper access to money. The system penalizes financial instability with more expensive access to money. The people who need cheap money most get the most expensive money. The people who need cheap money least get the cheapest money. This is not an accident. This is the design. You are 29. You have started to understand some of this. Not all of it, but enough. Enough to feel something that is not quite anger and not quite grief, but lives somewhere between the two. The feeling of understanding that the game had rules you were never given, and that the rules were always there in plain sight. And that plain sight, in this case, was buried in the terms and conditions of an account you opened at 17. You move the savings account. Not dramatically, practically. You find an online bank paying 4.5% on savings. You move the $900. The difference between 0.03% and 4.5% on $900 is not life-changing. But the difference on $9,000 is noticeable. And the difference on $90,000 is significant. And the direction matters more than the amount right now, because you are not at $90,000 yet. But the direction is where $90,000 begins. You start paying more than the minimum on the card, not because you have dramatically more money, because you have started understanding what 22.9% actually means across time. What $2,800 at 22.9% costs you over 3 years if you make minimum payments. The number the bank never showed you. The number that is on the statements in small print if you know where to look and what you are looking at. The number is $1,940 in interest. $1,940. To borrow $2,800 that you spent on things you no longer own. You pay it down aggressively. You do not use the card again until the balance is zero. The fourth invisible mechanism. Predatory lending. The payday loan store is not in the neighborhood with the wine bars and the artisan coffee. It is in the neighborhood where the $47 account balance is not an anomaly, where the ATM fee is not a minor inconvenience, but a genuine calculation, where the people who need $200 before Friday are the people who cannot qualify for the personal loan from the bank that would charge them 9%. And so they walk into the store with the bright sign and the fast approval, and they borrow $200, and they agree to repay $230 in 2 weeks. $30 on $200 in 2 weeks, which is 390% annualized. And the person who walks into that store is not stupid. They are not making a poor decision in the way the word poor is used to mean foolish. They are making the only decision available to them, given the options that exist at their income level and their credit score and their account balance and the distance between now and Friday. The system did not give them better options. The system gave them this option. And then the system built an industry around this option. And the industry is worth $9 billion a year, built entirely on the financial desperation of people with no alternatives. Here is what the bank does with your money while it is in their account. It lends it to corporations at rates that produce returns your savings account will never see. It invests it in instruments you do not have access to at your deposit level. It funds mortgages and car loans and business lines of credit that generate interest income that flows upward through the institution and appears eventually in a quarterly earnings report as profit. In 2023, the 4 largest American banks reported combined profits of approximately $100 billion. $100 billion. Built on the spread between what they pay you and what they charge you. Built on the overdraft fees. Built on the minimum balance penalties. Built on the credit card interest. Built on the ATM fees. Built on the fractional reserve model that takes your deposit and multiplies it into a lending operation you did not consent to participate in, because the consent was in the terms and conditions at 17. The bank is not your financial partner. The bank is your financial landlord. You are paying rent on your own money every month, whether you know it or not. Somewhere right now, someone is checking their account balance. The number is smaller than they need it to be. It is always smaller than they need it to be. And they are trying to remember if the automatic payment comes out before or after the direct deposit, because the timing matters. And the timing is always slightly wrong. And the $35 fee is always slightly possible. And the $35 fee is always the difference between a manageable month and a month that requires starting again. They are not thinking about the quarterly earnings report. They are not thinking about fractional reserve banking. They are not thinking about the spread between 0.03% and 22.9%. They are thinking about the timing. They are always thinking about the timing. And the bank is counting on exactly that. The bank is counting on the person with $47 being too consumed by the arithmetic of survival to look up long enough to see the architecture of the system they are surviving inside. Because the architecture is visible. It has always been visible. It is not hidden. It is just slightly above the line of sight of a person who is looking at a balance of $47 and trying to remember if the automatic payment comes out before or after the direct deposit. This is not a video about hating banks. You need a bank. The alternative to a bank at your income level is worse than the bank. The check cashing store, the payday loan, the mattress, all of them worse, all of them more expensive. The bank, even with the fees and the spread and the overdraft and the minimum balance, is still the least bad option available to most people. What this is a video about seeing the system clearly, because you cannot navigate a system you do not understand, and you cannot build anything inside a system that is quietly extracting value from you every month if you do not know where the extraction points are. Move the savings to the high yield account. Pay more than the minimum on the card. Know where the ATM fees are. Understand what the minimum balance is actually costing you. Read the terms, not all of them, the fees section. None of this is dramatic. None of this requires a finance degree. None of this changes the architecture of the system. The architecture is not yours to change. What is yours to change is your position inside it. And position begins with seeing. And seeing begins with someone telling you what to look for. Consider this, that.